Welcome class to week 6, chapter 5, operating and financial leverage. While you probably covered break-even analysis in other courses, the material in chapter 5 offers an opportunity to more fully explore the financial effects of all forms of leverage on the firm. The contrast between aggressive and conservative approaches should be emphasized, particularly through the useful technique of computing degrees of leverage. This chapter also serves as a good basis for much of the later discussion in the text on cost of capital. You will begin to appreciate the positive benefits of debt, but also realize that unlimited use of debt increases the financial risk of the firm and perhaps the cost of various other sources of financing. So what will we cover in this chapter? We will certainly talk about leverage representing the use of fixed cost items to magnify the firm's results, break-even analysis allowing the firm to determine the magnitude of operations necessary to avoid loss, operating leverage indicating the extent fixed assets like plant and equipment are utilized by the firm, financial leverage showing how much debt the firm employs in its capital structure. Combined leverage takes into account both the use of fixed assets and debt, and by increasing leverage, the firm increases its profit potential, but also its risk of failure. So what is leverage? This introduction emphasizes the airline industry as an industry that has both high potential leverage and high financial leverage. The bankruptcy of most U.S. air carriers should get across the point that leverage has its risk, and that this chapter is very important to anyone who intends to be a financial analyst or stock investor. So we're going to look at use of special forces or effects to magnify or produce more than normal results from a given course of action, with the recognition that we can produce beneficial results in favorable conditions, but we can also produce highly negative results in unfavorable conditions. So leverage in business, or the use of fixed charge obligations with the intent of magnifying the potential return to the firm, includes fixed operating costs. Those operating costs that remain relatively constant regardless of the volume of operations, such as rent, depreciation, property taxes, and executive salaries, or fixed financial costs, the interest costs arising from debt financing that must be paid regardless of the level of sales or profits. Operating leverage is the extent to which fixed assets and associated fixed costs are utilized in the business. Break-even analysis is the numerical and graphical technique we use to determine at what point the firm will break even. And the break-even point is the unit sales where total revenue equals total costs. Contribution margin per unit is sales price per unit minus variable cost per unit. And the formula for break-even point in units is BE equals fixed cost divided by the contribution margin per unit. So let's take a look at a break-even chart for a leveraged firm. So I'd like you to observe this for a minute and see what you see in what questions that you might have. With break-even analysis, there are established factors related to break-even that illustrate the operations of a highly leveraged firm versus a conservative firm. And in your text, this used figures 5-1 and 5-2 and tables 5-2 and 5-3. This slide shows the break-even point in 50,000 units, where the total costs and total revenue lines intersect. The break-even point can also be calculated in a different way, and this shows you the formula for another variation of break-even analysis. With volume cost profit analysis for a leveraged firm, we would use a more conservative approach. It would be a firm not willing to accept the additional risk of a higher degree of operating leverage because it will only commit to lower levels of fixed costs and thus operate further away from the break-even point where profits will grow at a slower rate. But if volume shrinks, there is more room to decline before hitting the break-even point and begin showing losses. The conservative approach is when some firms choose not to operate at high degrees of operating leverage, and we see more expensive variable costs may be substituted for automated plants and equipment, and it may cut into potential profitability of that firm. Here is an illustration of a break-even chart for a conservative firm, and another opportunity for you to take a look and see what your observations are and what questions you may find that you need answered, and certainly can be found through the activities that we're doing or in the text. Here we see a volume cost profit analysis for a conservative firm, and the risk factor in using financial leverage depends on the firm's operations relative to its break-even point and its operating leverage. How close to break-even volume is the firm's actual operating volume? Management's willingness to take risk is also a function of its view of future economic conditions. The risk factor in using financial leverage depends on the firm's operations relative to its break-even point and its operating leverage. So how close to break-even volume is the firm's actual operating volume? Management's willingness to take risk is also a function of its view of future economic conditions. With the cash break-even analysis, we're dealing with cash flows rather than accounting flows. It certainly helps in analyzing short-term outlook of firms. And examples of excluded non-cash items to remember would be depreciation, credit sales, and credit purchases of material. So let's stop here at degree of operating leverage and open again in week 6, chapter 5, part 2. See you there.